Let's jump right in. When someone says Goldman Sachs, you probably instantly think of the ultimate Wall Street investment bank, right? They're the ones CEOs have on speed dial when they want to launch a massive IPO, merge with a competitor, or navigate a crisis. And honestly, you wouldn't be wrong. But today, that description just isn't the whole story anymore. Welcome to this explainer. We're looking at a massive fundamental evolution. The modern Goldman Sachs is actually attempting the ultimate pivot, transforming from an episodic, deal flow engine into a durable, recurring fee asset compounder. To put that into perspective, it's kind of like shifting from being a luxury real estate agent who scores one massive commission every few years to becoming the landlord of a luxury high-rise who just collects premium rent every single month, forever. They definitely don't want to stop being that elite intermediary. Instead, they want to use that exact VIP position to source, manage, and compound assets for the long haul. Here is our roadmap for the breakdown. First, we'll map out this overarching shift from deal flow to asset compounder. Then we'll deconstruct their 5-layer business logic, explore the 8 specific engines actually driving their revenue, and dive deep into this massive asset management pivot. Finally, we'll run some financial forensics on their valuation and wrap things up with the very real risks that could derail this whole transformation. All right, Section 1, deal flow to asset compounder, moving from episodic to durable. Let's look at the tension between two totally different business models running under the exact same roof. The old Goldman flywheel was incredibly powerful, for sure, but it was episodic. Think about it. You build a relationship, you execute a massive transaction, you earn a huge fee, and then, well, you got to start all over again. It's fundamentally cyclical. If global M&A dries up, those fees dry up with it. But this new Goldman flywheel, it's built on long-duration, direct asset management. So in the old model, advising on a $10 billion corporate merger might yield a one-time $30 million fee. Nice, right? But in the new model, taking that same $10 billion and packaging it into a private credit fund yields $100 million in management fees, compounding over a decade. They are moving from simply matching capital to actively managing it directly, literally turning a one-time deal flow into a long-term annuity stream.
Moving on to Section 2, the 5-layer business logic. How they're bridging advisory and origination.
Let's trace exactly how a simple relationship actually turns into recurring revenue. It all kicks off at layer 1, senior client access. And let's be real, access is the ultimate scarce asset. You literally can't buy your way into a CEO's boardroom during a hostile takeover. But Goldman, they're already sitting in the room. That natural advantage leads right into layer 2, advice and execution. Then comes layer 3, risk intermediation. This is making markets, providing liquidity, and financing those clients. But here is the absolutely crucial pivot where the magic actually happens. Layer 4, asset origination. Because Goldman sees global capital needs way earlier than almost anyone else, they can uniquely package these opportunities, think bespoke private credit or infrastructure financings, into real investable assets. Which brings us to layer 5, asset management and distribution. Now they're distributing these packaged assets out to big institutions, wealth clients, and retirement channels. They aren't just advising on the deal anymore, guys. They are literally manufacturing the asset from scratch and managing the whole shebang. Section 3, 8 engines of revenue, deconstructing the cash machine.
To really understand the firm's engine room, you've got to separate the cyclical cash cows from the structural growth drivers. You have your classic super prestigious engines, right? Advisory fees, underwriting, equities, and FIC, which stands for fixed income, currencies, and commodities. Now, those are cyclical. But look at the bottom half of the list: financing, management and other fees, private banking, and incentive fees. Financing, just as an example, hit a record $11.4 billion in 2025. It's way more relationship-driven and recurring than just pure daily trading. And management fees, that is absolutely the heartbeat of this new durability strategy. Let's break down the 2025 revenue split in billions, just to grasp the sheer scale we're talking about here. You've got global banking and markets pulling in over $41 billion. Asset and wealth management is sitting at roughly $16.7 billion. And then you've got platform solutions at a tiny fraction of $1 billion, 0.15 to be exact. I mean, think about that for a second. Do you remember a few years ago when Goldman was going to completely revolutionize everyday consumer banking with Marcus and the Apple Card? Yeah, that tiny little slice is the remnant of that grand ambition. But let's zoom in on the big number, $41.45 billion. It is absolutely essential to understand that global banking and markets is still the heavyweight cash engine. Goldman Sachs isn't trying to just abandon its roots and become a pure asset manager like a Vanguard or a BlackRock. No way. They actually kept their crown as the #1 M&A advisor in 2025 for the 23rd consecutive year. To really get the modern Goldman, you have to realize they are using this massive, dominant franchise as the very top of the funnel. It originates the assets, it creates the access. It's the fuel that powers everything else. But this number right here, $16.68 billion, this is the strategic pivot. This is asset and wealth management, or AWM. Wall Street analysts are basically obsessing over this specific metric because this is where the firm actually builds a higher stock valuation. In the public markets, investors will happily pay a huge premium for the predictability of recurring management fees, especially when you compare it to the volatile roller coaster of traditional investment banking. AWM is the ultimate destination for all those assets originated by the banking side. All right, Section 4, the asset management pivot, building the new flywheel. Notice the really deliberate pattern in their recent strategic moves here. They aren't just making random acquisitions, they are building a massive global distribution pipeline. Look at January 2025, they create the Capital Solutions Group, building a structural bridge straight into the exploding private credit markets. But having products isn't enough, right? You need massive distribution. So by September, they lock in a partnership with T. Rowe Price, literally plugging Goldman's alternative assets into T. Rowe's gigantic network of retirement accounts. Boom. Then, in early 2026, they buy Industry Ventures to capture the super lucrative venture capital secondary market, getting right into the flow of tech liquidity. And finally, April 2026, they acquire Innovator Capital Management, snapping up $31 billion in assets and just vastly expanding their active ETF capabilities. They are systematically building scalable wrappers so they can sell their high-end institutional funds to a much, much wider audience. And here is the ultimate financial target management has set to prove to Wall Street that this pivot is actually working: a 30% pre-tax margin in asset and wealth management. Now, why is this specific number so absolutely critical? Well, raising assets is actually relatively easy if you just spend enough money. But doing it with a 30% margin, that proves this isn't just some bloated side project. It proves AWM is a highly efficient, scalable, capital-light machine that genuinely justifies a higher stock price. Moving on to Section 5, Financial Forensics and Valuation, reading the balance sheet. $3.65 trillion. Let that sink in. That is the record amount of assets under supervision they reported in the first quarter of 2026. This right here is the raw material of the new Goldman Sachs. And note that specific word, supervision. It's a really key distinction from traditional assets under management, or AUM, because it includes assets where Goldman provides advice and oversight, even if they don't hold full discretionary trading power. On top of that, they reported $62 billion of long-term net inflows in that single quarter alone. This is absolutely critical because it proves clients are actively opening their checkbooks and handing over more money to manage, completely independent of just the natural upward float of the stock market. So here is your exact cheat sheet for reading their hybrid financial statements. Because of this whole evolution, you really can't evaluate them just as a traditional bank anymore, nor just as an asset manager. First, you check return on equity and book value. They are still a heavily regulated bank, so this sets your baseline valuation floor. Next, you compare GBM to EWM revenue to track if they are actually shifting the business mix to get that multiple expansion we just talked about. Then, you track those AUS net inflows. Finally, you want to look closely at FICC and equities financing. If financing is growing prudently, it makes the markets division way less dependent on pure, unpredictable trading volatility. They're making steady money extending credit to clients rather than just betting on rapid price movements. So the crucial point is how you actually value the stock. You've got your traditional price to book, your segment-by-segment earnings multiples, and valuing AWM as an embedded asset manager. But the absolute holy grail here is the strategic flywheel premium. Think about it. If the investment bank creates elite access, which naturally creates investable assets, which the wealth management arm then manages, which then creates deeper client relationships that feed right back into the investment bank, that is a true, unbreakable flywheel. If management can prove these parts genuinely reinforce each other, the market is eventually going to pay a massive premium, recognizing that the whole is far, far greater than the sum of its parts. Finally, Section 6, Risks of the Transformation. What could actually break the model? Because look, while this strategy sounds brilliant on paper, it is absolutely not without peril. First up, unavoidable cyclicality. They can definitely become more durable, but they cannot eliminate global economic cycles. If global M&A activity shuts down, their revenue drops, period. Second, the private credit cycle. Look, these massive loans aren't marked to market daily, but severe credit losses still happen in a recession. Third, conflicts of interest. These are massive when you're advising a buyer, financing the deal, and investing your client's money right alongside it. Fourth, they are strictly constrained by banking capital rules. Fifth, asset management has to actually perform. Just raising the money isn't enough. Delivering alpha is what matters. And finally, the ghosts of their consumer business. Marcus and the Apple Card cost the firm billions of dollars and severe reputational headaches. It serves as a really stark, expensive reminder that when Goldman strays too far outside its core institutional DNA, it gets badly burned. Consider the deep truth in this quote, which brilliantly encapsulates their entire strategy today. Goldman's deal flow is not only a source of advisory fees, it can also be a source of assets to manage. They are literally attempting to make the premier investment bank on Wall Street the front end of an unstoppable, globally scaled asset management machine. Which leaves us with this final thought. Can the ultimate dealmaker truly become the ultimate asset compounder? If they pull this off, they break free from the boom and bust transaction cycle that has defined Wall Street for a century. But if they fail, well, they're still a highly profitable but highly volatile investment bank, forever chained to the economic cycle. The stakes literally couldn't be higher. Take a moment to consider how this massive shift toward private asset compilation might actually affect your own portfolios or how you view the modern banking system. Thanks for joining me on this explainer. Keep asking the hard questions, and I'll catch you next time.